This podcast is intended for investment professionals only. All investing involves risk. Hello, and welcome to the first of 2 episodes of Market Talk for the month of June. In this programme, we'll be looking at the softer US economic data. We'll be chatting through the result of the Indian elections. We'll be discussing our current positioning in both equities and credit. And in China, we'll be spotlighting the seemingly low yields on offer versus those of their Western peers. So, hosting the call from the UK is me, Frances Watson, and in the investment hot seat, as usual, Ben Bennett, who joins us from Hong Kong. At least I think you're in Hong Kong, Ben, because you've been travelling around so much recently. I'm not totally sure where you are at the moment.
Yeah, well, I'm definitely in Hong Kong now, but yeah, I was in Beijing earlier this week, and tomorrow I'm going to go to Singapore. So I'm having a full trip around Asia this week.
Oh, exciting. Well, let's go from Singapore to India. And we've, of course, we've had the announcement of the Indian elections. A reduced majority for Modi. Markets came off a little bit on the news. Where do investors go from here?
Yeah, it's amazing, and I think this is a year of elections, isn't it? We've got a load of elections. India is just the latest one. Actually, this weekend we had elections in South Africa, we had elections in Mexico, but the India ones are incredibly important, partly because it's the world's biggest democracy. I think 600 million people voted. The other reason is that Indian markets have been doing very, very well recently. And for investors, there was a perception that Modi would hold on to a majority and might even get a higher majority. And that was perceived, rightly or wrongly, as being good for equity markets. What he's done in previous years has certainly boosted equity markets. So when the exit polls, which are meant to be really good at forecasting what the result is, I mean, it's not a guess. You're meant to be asking people after they voted. When they came out, it looked as though Modi would have a higher majority. So the equity markets were rallying strongly. And then the day after, it turns out, well, perhaps that wasn't quite right. And Modi might not even get a majority, certainly lower number of seats than he had in the previous election. And Indian equity markets fell on Tuesday, 6% on the back of that. So you can just see how crowded the positioning was. So,
Yeah.
I mean, there's a few things you can take out of this. One is, yeah, prepare, don't predict when it comes to elections. It's a bit of a mugs game. Even if you get the polls, even if you get the exit polls, it's not necessarily the right case. And then the other one is sometimes even if you think you've got the right trade, a lot of other people will have exactly the same position. And if there's any sort of disappointment, then the moves can be big. I mean, I think structurally still, we still like India as a structural play. We still think, notwithstanding what happens in terms of who formed the next government, there's still a positive story. Certainly on the bond side, remember, Indian government bonds are being included in a lot of indices, and that's potentially going to lead to a lot of inflows there. So there's plenty of opportunity still within India. But yeah, prepare, don't predict. I think repeat that.
Okay, interesting. Now, we don't need to predict US data because we've had it just announced the last couple of days too, and it has been softer than of late. And I'm talking specifically the US JOLTS numbers, which are often a precursor, aren't they, to the big US payroll numbers, which of course we got later out this week. So, is this further evidence of US cooling? Do you think, Ben?
So JOLTS data, as you say, that's one way of looking at the US job markets, and that has just come out this week. And yeah, it was definitely cooling, and it's one of, I think, many different indicators over the last few weeks that has suggested that the US growth is softening. We had manufacturing sentiment indicators, so of course that's manufactured goods that cooled quite a lot. A couple of weeks ago, we had relatively weak retail sales. We spoke about that last time. So the consumer looks as though it's cooling. So you've got manufacturing, you've got the consumer, you've got the job market. We also had some inflation data last Friday, the PCE inflation, which is the one that the Fed looks at. That was in line, maybe actually a little bit lower than expected as well. So everything is pointing to the US cooling right now. In terms of the impact on markets, it's bad news is good news for the markets, which is always a bit funny when that happens. But right now, what it means with a cooling economy is that investors are forecasting, pricing in more Fed rate cuts in effect. So you're getting lower bond yields. So let's take the 10-year Treasury yield as an example. So at the end of April, the 10-year Treasury yield was about 4.7%, so pretty high at the end of April. Then we had this over the last few weeks, I guess the whole of May, really, we've had relatively disappointing data. So that's fallen down to about 4.3%, so 4.7 to 4.3. And over that period, the S&P has gone up 5%. So equity investors have cheered this slightly weaker data. Now, the question going forward is whether or not it continues to slow. Payrolls on Friday, we'll talk about that in a second, but payrolls are very important because it's great when you're in this Goldilocks range of slightly weaker data, but not recessionary. As soon as you
Yeah.
slip into
Yeah.
recessionary, I think bad news is bad news at that point. But at the minute, we're in this Goldilocks, bad news is good news.
Yeah, it feels like we are a little bit at a crossroads, just sort of waiting and thinking, what road are we going to go down, doesn't it? I mean, on that note, potentially, is that why the oil price has fallen? I had a look; it's gone from 80 something to 70 something now, hasn't it? Is it demand driven? Do you think?
I think partly it is demand driven, in fact. So the US demand has, it suggests the economy is weakening. They probably, in that case, would need less oil. And on Monday, after I mentioned the manufacturing sentiment weakness, that's the ISM manufacturing sentiment index, when that was a bit weaker than expected, there was a definite acceleration in terms of the fall in the price of Brent. It was down $3 on Monday, for example. We also over the weekend had an OPEC plus meeting. So this is, the cartel that sorts out how much production there's going to be, and they announced that they were going to continue to cut or to extend the production cuts, but some are going to be phased out from October. So at the same time as you've got slightly weaker data, you've also got OPEC plus saying, we're gonna cut production, but a little bit less than we were before. So in effect, they're going to be increasing production, aren't they? So I think
Mm.
that was partly due. I think that's one of the reasons why Brent was falling. Now, if you're the US consumer, the Federal Reserve, you probably up to a certain point at least cheer the fact that oil is come down in price because it allows you to spend your money on other things. So I'd say this is broadly again a positive for markets as long as you're not producing oil, of course.
Okay, interesting. Yeah, exactly. Now let's go to current thinking then, Ben, because we've had a bit of change in our asset allocation, haven't we? I mean, we've been underweight equities for much of the year. Seems now we're adopting a more neutral stance. What's behind that thinking?
Yeah, so in isolation, it looks as though we've sort of capitulated on our underweight equities view. But what we've really done is we've shifted our underweight equities to being now more underweight corporate bonds, credit. So we're still cautious. I think we've reiterated a few times why we're cautious. Basically, it's the fact that the markets are pricing in this Goldilocks perfect scenario. Valuations are relatively stretched, I would say, and that any deviation from this Goldilocks, be it on the downside in terms of weaker economic growth, or on the upside, if we were to see a reacceleration and inflation starts to look sticky and the Federal Reserve has to hike interest rates by more, both those things I think could undermine valuations. But on a relative basis, we think there's probably, if the Goldilocks scenario continues, equities could continue to go up. I mean, equities ultimately on the upside are unbounded, aren't they? They can go up forever.
Mm.
But credit spreads where they are today are pretty much at the close to the all-time tights, 10 basis points away from the all-time tights. So they are bounded in terms of how much they can go up. So we just wanted to take that sensible decision, we think, moving that underweight equities to being more underweight credit, but still relatively cautious going forward.
Okay, so in conclusion, it's a relative trade then between equities
Yeah,
and credit. Yeah. Okay, got
yeah,
it, got it.
that's right.
Now let's go back to bonds. You mentioned, of course, that market bond yields in the developed countries at least still above that 4% mark at the US 10 years.
Yeah.
But nominal yields in China just over the 2% mark. That's seemingly low to me, Ben. Is that about right, or should they be higher?
So China is a really interesting really interesting thing to look at from a bond perspective. So 10-year Chinese government bond yields, you're right, they got down to 2.2%, not quite 2%, but nearly 2.2. But then the Chinese central bank intervened verbally. They sort of rang up, I guess they rang up or sent an email to a load of banks in China and said, look, we're uncomfortable that yields are a bit too low. To your point, that if we're growing, the economy is growing at 5%, that maybe yields should be high, and you banks should be a bit more careful, and maybe you should take some of those long positions off and let yields go up. And yields have gone up from 2.2 to 2.3. Now, my problem with that is that inflation in China is really low. It's about 0%. So when you think about real yields, which is the nominal yield minus inflation, and that from a company perspective is really important, because that's how much you're borrowing minus how much the thing that you're selling is going up in value. So I mean, if you're selling cars and the price of a car goes up 10% every year, then you're very happy to pay, I don't know, 5% yields, because it's getting eroded away by the fact that you're selling these
Sure.
cars at 10% higher every. But if the car's not going up in value at all, like in China, inflation is zero, then that 2.3% that you're paying is real. That's what's costing you. And I think that, if anything, is a little bit too high for China, based on the fact that they're going through structural difficulties that we talk about an awful lot. They're moving their economy. It's a difficult thing to do, and maybe the Chinese economy could do with slightly lower real yields. But that's just my thoughts.
Yeah, because of course their problem is deflation potentially rather than ours, which is still sticky inflation, isn't it?
That's it, and you really don't want to get the deflation set in stone. And this was the problem in Japan for many years. They were in deflation. Their yields went down to basically 0%, weren't they? Japanese government bond
Yeah,
yields, but that was
yeah.
still a positive real yield because they were in deflation. So actually, the nominal yield minus the inflation was the deflation was still positive. And just talking about China, there's a really important meeting coming up. It's called the Third Plenum. It's just been announced for July, which is still about 9 months too late. Well, it's normally 9 months earlier than this, but I guess better late than never. And on the third plenum, we're expecting more details about economic support, maybe reform, etc. So that's really something to focus on. Markets, Hang Seng, for example, has been up pretty strongly this year so far. So it was up 15% year to date up until the 20th of May. It gave a bit of that back to the point of up to yesterday, Tuesday, it was only up 8%. That's still up 8%, it's given up a little bit. But to get the next leg of that rally going, I think we're going to have to see something interesting, useful economic reforms, etc., out of that third plenum in July. So keep your eyes peeled for that.
Yeah, exactly. And we will do. We definitely will do. Now, on the financial horizon, we've got some important data coming out Thursday and Friday of the remainder of this week. Starting with Thursday, Ben, and we've got, well, this interest rate cut that we think we're going to get from the European Central Bank. That said, inflation is ticking up a little bit in Europe. So talk us through what's expected and where we can go on from there.
Yeah, the ECB has sort of pre-announced, in effect, the rate cuts. It'd be a big surprise if they didn't cut interest rates tomorrow. But since, in effect, pre-announcing it and reiterating it every time one of the governors speaks, since doing that, we've actually had some better data out of Europe. Inflation data was stronger than expected. GDP a few weeks ago was expected. We had some wage data as well that was pretty strong. So investors are still expecting a cut tomorrow, but then maybe wondering if there's going to be a period where they're going to be on hold. So we still think that there's two more cuts, but markets have got something between one and two. There's 64 basis points worth of cuts, to be precise, as of Tuesday's close priced in. So that's two and a bit. So tomorrow's rate cut plus one and a bit going forward. So yeah, maybe one cut and then on hold, which is still not particularly dovish, is it? It won't be that supportive, but at least the economy's done a bit better recently. The Fed, which is going to be announcing their policy decision on the 12th of June. That they're expected not to do anything on the 12th of June, but probably cut a little bit later, and maybe cut twice this year. That's what's broadly priced in. And for them, really important is Friday's payrolls. I mentioned it earlier. they need a sort of Goldilocks number. They need a number, let's say, between 150 and 200,000 job creation. That would be good for them. That would mean that job market's slowing, allowing them to cut. If the job creation is under 100,000, there could be some question marks about whether or not the economy is slowing too quickly. Hard landing might be discussed. If it's more than 250,000, then we're back in. Things are getting a bit too hot. Higher for longer rates. Maybe the Fed can't cut again. So again, we're hoping in terms of for markets to rally for that perfect middle ground, that perfect Goldilocks.
There's lots of mulling over, isn't it, on this data? Of course, have you mulled over your number for the week, Ben? And if you have, what is it and why?
I have, yes. So the S&P 500 earnings season, Q1 earnings season is now finished. So I had a look. What was the outcome in terms of earnings growth? It was 8%. So that's my number of the week. 8% over this quarter, the Q1 earnings compared to Q1 earnings last year, 8% higher. So that's really good. And one of the reasons, like we discussed before, why we've covered our underweight on the S&P on equities in general, because earnings are still pretty good. But I guess another number of the week could be 24%, because that's how much the S&P is up over the last year. So earnings are up 8%, but the market is up 24%. Well, that's 3 times, isn't it?
So
So
way ahead of it.
that
Yeah.
suggests that investors are getting ahead of the earnings growth and are hoping that it continues in perpetuity, for another few years at the very least. And that's the reason why we have that more medium-term concern about markets. That's easily disappointed, isn't it? So 8 and 24,
And
my
I was
2
going to
numbers of the
ask
week.
actually on that 8%, how broad-based is that? Because the thing is, the Magnificent Seven, how much does that take up of that earnings
Yeah,
increase?
a large amount. And I just looked at the tech sector, and the Magnificent Seven is not just in the tech sector, of course, but the tech sector earnings were up 30%. So you
Yeah.
can see the difference there. Technology is really driving this, AI and the Magnificent Seven.
All right. Well, Ben, on that note, thank you for driving this podcast. And thank you to all our listeners. And of course, we'll be back at the end of June, Ben. But until then, good luck with the rest of your travels. Been great to see you. And we'll speak again soon. As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal and General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market, or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal and General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal and General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.